When rent is due on the 1st, but payday falls on the 15th, waiting 2 weeks to access money you have already earned can cause real financial anxiety. Earned wage access platforms like DailyPay promise to solve this exact problem by letting you unlock wages early, but understanding how the service works requires looking beyond the smooth app interface and looking into the terms that control your money. The primary feature DailyPay provides is on-demand pay. When you work a shift, your employer tracks those hours, and DailyPay updates your available earned balance. You can then choose to transfer a portion of those unpaid earnings to your personal bank account before your regular payday. The fear many users have is that this functions like a payday loan with hidden, sky-high interest rates or surprise debt collection tactics. Legally, DailyPay operates on a non-recourse structure. This means when you request an early transfer, you are selling your right to receive those specific wages to DailyPay rather than taking out a consumer loan. If your employer fails to pay DailyPay due to business insolvency, the terms state that DailyPay cannot pursue you for debt collection, report you to credit bureaus, or take legal action to recover those funds, provided you have not committed fraud or breached the user agreement. Understanding fee structures is where many users run into unexpected costs. Transfers requested for the next business day via standard ACH are available at no charge. However, if you need funds instantly to cover an emergency, DailyPay charges an instant transfer fee. This fee generally ranges between $1.99 and $3.99 per transaction, depending on your employer's specific partnership agreement. While a $2.99 fee might feel small in isolation, taking multiple instant transfers across a single month quickly adds up. Taking 10 instant transfers in a month can cost nearly $30 in fees, which functions similarly to an annual interest rate on small cash amounts if relied upon routinely. A common operational concern centers around what happens on your actual payday. To facilitate this service, DailyPay sets up a designated routing and account number where your employer deposits your full net pay. When payday arrives, DailyPay automatically intercepts the funds, deducts the wages you already accessed along with any instant transfer fees, and automatically forwards the remaining balance to your primary bank account. This setup leads to the question of why a paycheck might look much smaller than expected. If you access 70% of your earnings throughout the pay period, your final direct deposit on payday will reflect only the remaining 30%, which can create a recurring cycle where you are forced to use the app again for the next bill cycle. Privacy and data sharing also play a critical role in the platform's operations. By agreeing to the terms, you authorize your employer to share data regarding your shift hours, hourly wage rates, gross earnings, and employment status directly with DailyPay. In turn, DailyPay tracks your transfer history and account activity. The terms specify that this data is used to calculate available transfer limits, verify employment, prevent fraudulent activity, and maintain service operations. The main takeaway for using DailyPay effectively is to treat it strictly as an emergency buffer rather than a regular cash flow strategy. Utilizing the free next business day ACH option eliminates extra fees entirely. Planning transfers around fixed expenses helps prevent payday shortfalls and breaks reliance on early wage access.